Wednesday, June 28th, 2023. Thank you so much for joining me today. And in this video, I'm going to talk about the 3 reasons why juniors have tanked. Now, in a recent video, I mentioned the reasons why gold has held up really well. And we know that gold has held up really well. Everything else in precious metals and commodities has not, the stocks, the juniors, commodity prices, etc. And so there was a comment that said, well, why don't we hear about the reasons juniors have tanked? And maybe that was made in jest, but I thought that's a good idea for a video. So that's why I'm here recording this video. Now, getting into it, I have a chart or two here before we get into the reasons. But first of all, Marin Katusa posted a chart. Excuse me, shout out to him, showing how the volume in the TSX Venture has been really low. Now, that was only back to 2013. So I took it upon myself to post this chart, at least in this video. We have the CRB here, it's commodity prices. The TSX Venture, that's the junior index. And then we have the volume of the TSX using a 10-day moving average. Now, a couple things. Now, the CRB, I mean, you look here, they tend to follow each other. I mean, the TSX, what I should say is the TSX follows commodity prices. Now, I would say it's a leverage to it because if the CRB is not rising, the TSX Venture will perform much worse. You saw that here, 2011 to 2014, a slight downtrend. TSX had a decline here. Much bigger decline, of course, during the GFC. And also, we're at an interesting point here, kind of similar to the early 2000s where, the CRB and especially, more so gold and silver, they were doing much better at this point. Well, the CRB, I mean, even here, it had a breakout here at the end of 2003, and the juniors in the TSX Venture, they had not really responded yet. Like, they did not really get going until after that, until the end of 2003. And it's just interesting because you had a bottom in commodity prices in 2001. As I said, gold was already performing well. The larger miners were performing really well. That started at the end of 2000. So there was a couple-year lag here in the juniors. And maybe we're seeing something similar this time because commodity prices they're stabilizing here. They're holding up pretty well. Although if there is a recession, I bet, we get a leg down here before it goes back up. But, you could see commodity prices so far have held up, reasonably well. But, the juniors have really taken a big dump here. And, one thing is we have to talk about the construction of this index. And I don't know off the top of my head, but it's not 100% junior exploration companies and junior mining companies. There's weed stocks that are in it. There's a lot of tech stocks. And so, perhaps, tech stocks plunging, that has contributed to part of this decline. Also, weed stocks, they've been a disaster as well. So I think that's part of it. But, nevertheless, I think what the juniors need, you need, commodities to make the next move up, gain more traction, and then I think the juniors will follow as they did here, when a real bull market was confirmed. But getting down to the volume here, we can see, and I'm using a, 10-week moving average. This is a weekly chart. You could use a 20, 30, 40, 50-week moving average. It's all similar. But, based on this volume is at a 20-year low. So this is the lowest that it's been, since down here. And obviously that was a really good time to buy. I love 50, 100-year charts. This doesn't go back far enough. But you can see based on this drop, people are really giving up on the sector. So let me get into some of the reasons here. Well, actually the top 3 reasons, and I'll just run through these, or you can just put the video on mute as I talk here and read them for yourself. So first you have a major decline in metals prices. Kind of obvious, metals prices are down a lot. Now we know that gold has held up really well since it's high. Silver's off 25%, off its high by 25%. Now these, I use an index, I think it's a Goldman Sachs index of industrial metals, energy prices. You could get those indexes on stock charts. Industrial metals are down 35% off their high. Energy the energy commodities, are down 45%. So these are some serious declines in commodity prices. So that's not good. That's going to hurt the sector. Secondly, and this applies to commodities X gold, or really X precious metals, but you have growth and demand concerns. I mean, there's all this concern that there's going to be a recession. You have these indicators with a perfect track record are telling you recession is coming, and the Fed has been tightening. This is the second biggest tightening cycle, really historically. I mean, potentially, you'd have to go back and compare it to the one from 68 to 70. But, this might be the second biggest tightening cycle ever. Obviously, the biggest was there at the end of the 70s, early 80s. But, look, the Fed's tightening. Real interest rates are going up. You have recession risk. That's not good for commodities. And then finally, this is the real biggie. You have rising costs, but also inflation it's sticky. Commodity prices have come down, but ex-commodity prices, inflation has been really sticky. The core CPI is still at 5%. It's barely moved despite the fact that they've gone from 0 to 5% rates. So, and rising costs for producers, that is the biggest problem. That's really the biggest problem. When you're looking at, of course you have sentiment at the same time. Sentiment's really bad. So, with the volume, I showed that. So people are losing interest. But, that's based on the fundamental development that, look, it's a double whammy. Metals prices have come down significantly, but the cost to run a mine, just generally, not just a gold mine, but any of these other mines, they're up significantly in the last 3 years. And I want to get to a tweet showing this. Thanks to Christian Gopal. I'm sorry if I'm butchering your name, but I wanted to give him credit and include him in the screenshot. This is from Metals Focus showing, the AISC, the all-in production costs for gold miners. I calculated this. This is Q1 of 2020. So Q2, this is Q3 of 2020 when metals prices and share prices, precious metals prices and share basically peaked right here. So this is below 1,000. Okay, this right here, this is 3 years later, or it's 2.5. It's like 2.5 years later. This is at 1358. This was right here at the peak. That was below 1,000. It's at 1358 now. So I calculated it's like 46% or 47%, but 45% sounds better. That's just in the last 2.5 years, really. But they'll probably go up a little bit in the next quarter. Maybe they'll be up to 50%. So that's the reality of where we are. Metals prices, commodity prices are way down because of this. Sentiment's terrible, and the costs to run mines are way, way up. So it's not rocket science. That's why everything's in the tank. But, I think after this coming recession, we're going to have a huge move up here again. I hate to say that, after something that it's not imminent, but I think that's the reality. So, now's the time to, buy best of breed companies. You can get them really, really cheap. And look, you got to be focused on gold first. If we're going to have a recession, you focus on gold first, then silver when gold breaks out. Then when you make money on those and the recession is almost over or it's ending or the recovery is in its, very, very early phase, that's when you want to go into copper, energy, the other commodities. At least that's how I see it. All right, so those are the reasons. Leave a comment. Let me know what you think, and I'll talk to you guys again in the next video.